Good afternoon. This is Ken Long from Tortoise Capital with a review of the weekend trading report for November 8th, 2014. Market has pulled back into bullish normal conditions. On an annual basis, using weekly RSI 14, we're at the higher end of neutral at 63 out of 100. With the 10-day NDX for shorter term conditions, we're overbought at 97 out of 100. Price with respect to the 200-day moving average is white bullish at 6.68, so it's improved in the last 10 days. Slope of the 50 is yellow neutral at 0.17. ADX is at 22.8, still neutral but with bulls in charge. ATR percentage has dropped down to 1.04%. That's almost a 50% drop in the short-term volatility compared to 2 weeks ago. The risk index is the 30-period moving average of the VIX divided by the 10-period. It comes in at a score of 1.21. That's above the 1.0 threshold between risk on and risk off, so we are into risk on conditions, favorable holding expectation for riskier assets. Take that score of 1.21 on the risk index, compare it to the last 5,000 trading days, find the standard deviation. That gives us the risk Z. Right now that's at 2.49. You can see the last 90 days of that indicator on this time series. Notice the smooth oscillations here between risk on and risk off. It's gone from 0 to a -2 Z-score to a +1.5 to a minus almost 3 and now to a plus 2.5. This has been a 40% swing trade move in XIV. To accompany an 8% rebound in the S&P during that time frame. You can see the holdings here. In blended monthly rebalancing, these are the current winners based on Friday's closing price action. And these are the leading candidates in each of these portfolio populations. In ETF2, the theoretical exposure is at 40%. The model portfolio is at 50%. These are just a quick look at the ETF 13 and 32 and the ETF Max for your reference. The S&P 500 looked at through the same lens along with the key symbols or the S&P spider symbols that these symbols are a member of. See the domination by XLV and XLP. Market health check. You can see the rebound that we've had here in the last 20 days from 183 to 203. So it's a 10% bounce. Dark blue shaded area is the river. That's the 30-period Bollinger Band defining normal, ±1. Lighter blue shaded area is the floodplain, 30-period Bollinger Band, ±2. The vertical blue lines are 10, 20, and 30 days worth of look back. The horizontal red lines are support levels that used to be resistance levels and which should continue to be support until violated. If they get violated, then those become price targets on the way down. The purple line was the most recent price target on the way up. That resistance now looks like a reasonable place to draw some support here. We'd like to see the market long-term hold above 202. This sine wave looking black line is the 30-period regression line slope value. You can see that marks off key turning points when that slope value gets to extremes. That's why I like tracking it. The blue channel here, those three lines are a RAF regression channel, period 10. The center line is the regression line, which is the best fit line. And then the outer channel is formed by the maximum excursion during the look-back period. You can see the difference between the variation of the last 10 days and the last 30 days, which are marked off by these black lines. So this is the 30-period regression line. Here it's lagged a day. And that's the slope of that line is what creates this time series line here, which I've marked off at key turning points and when it crosses the zero line. When it crosses a zero line, that's definitely favorable. Right now that reading is at 0.28. It's almost but not quite sharply up. If it gets above 0.40, then that's statistically an extremely steep slope. You can see that there was still some price action on the downside here. This is going to continue to get steeper once we start dropping off these losing days. That line's going to get really steep and look extraordinary. The Williams percent R here shows that we've been overbought now for about 12 or 13 days. It can stay overbought that long. That's how long it stayed overbought here. Back in August, the last time we were up here in the 200 area. The percent price oscillator, it functions like MACD histogram. You can see the jaws are open to the upside. The turning point we found right here, which occurred right after this sharp sell-off, and then about two days of improvement. That's why I like looking at this indicator. It gives us early warning. It found the turning point here. Just prior to the big sell-off, jaws were open to the downside the whole way. Jaws have been open up the whole way. That's a pretty good oscillator for finding turning points in the swing trade. Six of the 10 broad indexes are still below their 4-month moving average, so they signal cash. For their MA filter, the 4 U.S. symbols are all above their 4-month moving average. Excuse me. The globals, global market condition favors the U.S. over the internationals. The S&P at 81 is better than EFA at 68. Inside the U.S., the strength is technology at 85, then large caps 81, and small caps 79, and mid caps 78. Two strongest sectors are large caps and tech. Two weakest sectors are Latin America at 64 and Europe at 66. Almost everything in the U.S. large cap universe here is above average. Only energy is lagging, but otherwise you are exceptionally well off if you're in the S&P. World market model, everything U.S. above average, technology especially so. Everything Europe is in yellow or red. Japan is above average, Asia less Japan below average, only India dominating in the Asian countries. Latin America well below average, emerging markets below average. Canada and Mexico below average, Brazil certainly hurting. Commodities, oil, gold, silver, all especially weak. Treasuries, bonds, real estate above average, and private equity slightly below average. You can see the domination of the U.S. Business sectors expressed by the XL series, the sector spiders, compared to their European their global counterparts. Excuse me. But strength in healthcare is certainly a worldwide phenomenon. The strong dollar still contributing to equity price improvement. No change, in other words. Just for your reference, quick looks at the ETF top 30 using the ETF2 model. And the Dow 30. Visa continues to do well. It's green and white. 3M continues to do well, green and white. Johnson & Johnson, DuPont, and Coke, all in green and white, looking good. Only IBM is suffering with the red and the yellow. United Tech and McDonald's may be early in the improvement phase here with a white and a yellow, whereas Disney is starting to lag here with a white and a green. ETF liquidity, just for your reference. Quick look at the daily report. No signals in the overreaction or channeling. Only a couple 551 signals, and then the auto framer. These are symbols that all frame out better than 2 to 1 on a 10-day trade basis. You can see just how much volatility had peaked and then has rolled back towards normal. Right at the 100-day normal now. And ADX slowly improving with bulls in charge. That's favorable for the long term. Declining volatility plus rising ADX and bulls in charge is good news for the long term and swing trades on the long side. No signals in the Dow 30. a handful of favorable frogs. All these that are over here in the green under the NDX are ones that closed at a new either 10-day, 1 month, or 3 month high, depending on if it was above 100. Visa looks interesting here. Exceptionally strong performance. A triple screen in treasuries and 551W signals in Asia less Japan, and then a half dozen that test out well on the auto framer. Nothing, only VIX on the RSI2 signal. XIV is almost completely healed once more. Quick look at some auto framer candidates for Monday using the auto framer and then also the regression line fractal. And that's everything I want to cover for the executive summary. With the exception, you can see just exactly how sharply that volatility spike of the last 20 days was expressed here in the regression line slope. I love these turning points that are marked. When it gets a turning point outside of one standard deviation above the 6 month normal, that really gets my attention. That gave us some alerts on a bi-directional trade here. So that's Ken Long from Tortoise Capital. Keep your risk measured and your powder dry.